the Internal Revenue Safe Harbor. What does this mean? There's been many, many Ponzi schemes in the United States. Some, and there's a specific definition for a Ponzi scheme. It's where somebody fakes that there's any real investment, for the most part, and uses other people's money to pay each other off in a criminal action, in a defrauding action. Right? That's the bottom line definition of a Ponzi scheme. When there's a criminal action filed against a Ponzi scheme perpetrator, the Internal Revenue Service has realized that for sure there has been a certain kind of a financial theft. There are certain types of financial theft that get very good treatment in the Internal Revenue Code. They're treated on a dollar-for-dollar basis. When you take the deduction, you don't have to reduce the amount of the deduction because of, as in the case of medical expenses, where you have to take a percentage of your gross income before you're entitled to any medical expenses, things like that. The theft loss deduction, the certain kind of theft loss in financial schemes, is a valuable deduction. If you're in the 35 to 50% tax bracket, whatever tax bracket you're in, you're going to get back real dollars. If you're in the 50% tax bracket, for every $1 of theft loss you claim on your tax return, you're going to get a real value worth 50 cents in taxes you don't pay. If you're in the 20% tax bracket, the value would be 20 cents. But it can be in the form of refunds from past taxes paid. It can be in the form of not paying future taxes if there's been the right kind of theft loss. Now, in the case of a Ponzi scheme with criminal actions, IRS knows the parameters that they are not going to win in court. And therefore, what they have done is they've come out with what's called a safe harbor, meaning they know if you fit certain rules, if you've been injured by a Ponzi scheme, if there's a criminal action filed, if you fit a few other rules, then you are basically going to win your administrative case, so why not make it much easier for you? And they've done that. They've done a wonderful job of providing what's called a safe harbor. One has to really study whether they fit in it, and it can be handled without major issues, really. There's two other kinds of areas, though, that we need to deal with. What the safe harbor is going to allow the person who fits in it to do is to show their basic proof of loss, show that they have paid tax on income that they may never have taken out of the account, but paid tax on it, called phantom income, and then take a predetermined percentage of that loss in the year they discovered it, based on what else they're trying to do with lawsuits or insurance policies, whatever else they're trying to do to recover that money. Somebody who has no insurance policy, no lawsuit, no way to recover any of their Ponzi loss can deduct 95% of their loss plus the amount they pay taxes on. Now, to the extent that you have invested money and paid taxes on money that's still there, then that's loss. However, anybody who has taken cash out against that account is going to reduce the amount of your loss. When you get all finished, however, the safe harbor is going to give you the easy administrative way to calculate all of this. And those can be handled administratively by me anywhere in the country.